51%. I mean, just let that sink in for a second. 51%. Right now, a single application, ChatGPT, literally owns over half of the entire generative AI market. We're looking at a sheer, undeniable consumer monopoly. And honestly, it's the exact engine fueling today's absolutely unprecedented infrastructure supercycle. Welcome to The Explainer. I'm really thrilled you're here with us. Today, we're going to take a really clear-eyed look at this massive and frankly kind of crazy disconnect between record-breaking market highs and the growing structural risks bubbling just beneath the surface. Our journey today is all about the state of the markets, AI, space, and shifting tides. If you've been glued to the tickers lately, you know things feel a little, well, paradoxical. We're going to use this explainer to unpack exactly why that is, connecting the dots between these massive macro rallies we're seeing and the micro bottlenecks that could completely derail them. So here is our roadmap for today. First, the market paradox. Second, the AI capital squeeze. Third, sector hype versus reality. Fourth, navigating macro frictions. And finally, strategic positioning for 2027. Let's dive right into part one, the market paradox. Unstoppable rallies amid rising friction. Right now, financial markets are completely ignoring physical reality. We literally have this massive paradox going on. Think of it as the streak going head-to-head with the friction. For the streak, we're talking about 5 straight days of tandem records across all major indexes. Dow crossing 51,000, S&P over 7,600, Nasdaq over 27,000. And the fuel here is high beta, super volatile equities surging over 58% year to date, totally leaving low volatility stocks in the dust, which are up just over 7%. But then you hit the friction. Brent crude oil is pushing $96 a barrel. The 10-year Treasury yield is creeping up to 4.49%. Plus, we've got active, ongoing geopolitical exchanges in the Middle East. It's wild. Speculators are aggressively chasing momentum and completely looking past the mounting real-world friction. Moving on to part two, the AI capital squeeze. Let's talk about where the money actually flows. Now, absolutely nothing has more momentum right now than artificial intelligence. But, spoiler alert, building the future is not cheap. Alphabet's massive, incredibly healthy operating cash flow sits at around $214 billion. Sounds great, right? But check this out. Their projected 2026 capital expenditures, just to keep up with the AI infrastructure race, are a staggering $190 billion. Big tech's ambitions are growing so fast that they are officially threatening to eat up their own historic cash flows. So how in the world do you plug a gap that large? Well, Alphabet is doing it with a massive $80 billion equity raise. And notably, this includes a $10 billion private placement buy-in from Berkshire Hathaway at a 6% discount, which offers some really serious institutional validation. But hey, there's a warning light flashing here for retail investors, and it's all about shareholder cost. For the first time since 2017, Q1 share buybacks hit zero. The capital burden is actively shifting away from traditional shareholder returns and being poured directly into data centers. But where exactly does all that $190 billion flow? It flows right into the picks and shovels ecosystem. The secondary players catching this CapEx waterfall are reaping huge immediate rewards. Broadcom recently closed at an all-time record, hitting a $2 trillion market cap, up 14%. HPE is surging nearly 20% on server demand. Marvell Technology, sitting at a $254 billion cap, saw a massive surge, especially with Nvidia's Jensen Huang famously dubbing them the next trillion-dollar company because of the advanced networking required for these centers. And we absolutely can't forget power and cooling. Companies like nVent, Eaton, Schneider, Vertiv, and Trane are exploding because guess what? These data centers run incredibly hot and require massive energy infrastructure. But hang on, here is where we hit a massive bottleneck, the data center deployment gap. You see, pouring billions of dollars into a spreadsheet is easy. Actually building the thing is incredibly hard. It starts with secured capital inputs, but then the funnel narrows drastically. First, you hit acute supply chain backlogs for all those advanced cooling components. Then you're looking at severe local permitting and zoning fights. And perhaps most critically, power supply limits. The grid fundamentally cannot handle the massive megawatt requirements of these new centers right now. So the physical reality of the AI build-out is violently decoupling from the sheer velocity of the capital being thrown at it. So why push through all this headache? Because the consumer prize is unparalleled. As we talked about right at the start, ChatGPT holds over 51% of the market. They reached 1 billion monthly active users faster than Google Maps, TikTok, or Instagram. Right now, ChatGPT is larger than Gemini with its 472 million users, DeepSeek at 68 million, Meta AI at 61 million, and Claude at 56 million combined. That sheer undeniable consumer dominance is the fundamental justification for big tech's relentless spending. All right, part 3, sector hype versus reality. Let's look at space and speculation. This intense hyper-growth mentality definitely isn't isolated to AI. The space sector perfectly captures the crazy contrast between a halo effect and harsh gravitational reality. On one hand, you have the ultimate catalyst, SpaceX targeting a truly unprecedented $1.75 trillion IPO valuation. And this creates a powerful draft effect, pulling up valuations for companies like INEO to $19 billion in its wake. But then, look at Virgin Galactic. They just experienced their worst trading day ever. Why? Because they essentially had to hold a desperate big sale, issuing 2 million shares just to scrape together the cash to redeem a $10 million note. When you only have $250 million on hand, but you're projecting a $220 million burn rate through Q4, yeah, the hype evaporates very, very quickly. And this speculative fervor is also completely changing how we trade. Look at the evolution of speculation. We started with traditional, highly regulated institutional exchanges like the CME and SIBO. Then we moved into the retail-driven, event-based, highly engaging world of sportsbooks like DraftKings. Now, we are fully in the era of prediction markets, specifically platforms like Kalshi, which perfectly synthesize those fun, gamified interfaces with serious, hard-hitting derivative structures. And the impact of this evolution is immediate, and it is brutal for the old guard. When Kalshi recently secured CFTC approval for perpetual futures linked to Bitcoin, which means no expiration dates and direct applied leverage, the traditional institutions took a massive hit. CME stock dropped 11%, and CBO stock plunged 20%. This democratized, high-leverage speculation is fundamentally threatening the core multiples of traditional exchange stocks. Okay, part 4, navigating macro frictions, geopolitics and regulation. Now that we understand the internal market hype, we really have to zoom out and look at the external forces threatening the market's fundamental stability. First up, we're seeing a massive regulatory machine pivot. Influence is actively flowing away from independent agencies and directly into the executive branch. We're seeing mandates requiring these independent agencies to submit major regulations directly to the White Wing Budget Office. We're seeing aggressive personnel shifts, like the clearing out of specific FTC commissioners. And crucially, a massive revival of dormant Section 301 tariff rules. Now, regardless of where you stand politically, structurally speaking, this consolidation of executive power injects a huge amount of friction directly into global tech supply chains. Then there's the geographic drag. The Middle East is in a state of limbo right now. We have ceasefires on paper, sure, but in practice, direct and heavy fire continues to be exchanged between the US and Iran. Energy historian Daniel Yergin provides a really vital insight here. Even if the Strait of Hormuz experiences a swift reopening or de-escalation, that absolutely does not equate to a swift return to normal for global energy markets. And that's exactly why we're seeing Brent crude actively pushing toward that $100 per barrel mark. So let's see how this all builds into a timeline using macro strategist Marco Poppett's 2027 risk radar. In the next 6 to 12 months, the primary risk is sticky inflation, driven by that $90+ oil, which could potentially force central banks into unexpected rate hikes. Looking 12 to 18 months out, we face the lockup avalanche. This is when early investors in mega IPOs like SpaceX and OpenAI finally reach the end of their lockup periods, likely flooding the market with trillions of dollars in securities all at once. And finally, by 2027, we hit the CapEx ceiling. The sheer mathematical limit of AI infrastructure spending acceleration will eventually hit a wall, and that's going to shock markets that have become dangerously conditioned to hypergrowth multiples. Which brings us to our final section, Part 5, Strategic Positioning for 2027. So, with capital squeezes, massive geopolitical friction, and lockup avalanches all looming on the horizon, what do we actually do? Well, we need a clear, actionable framework, and it starts with understanding a fascinating historical truth, the low beta anomaly. Historically, low volatility, or let's just call them proudly boring, stocks actually traded at a 20% premium because they are reliable. They survived the 1930s and the 2000s without a single losing decade. But right now, because retail investors have drastically overpaid for volatile high beta momentum stocks, beating low beta by an insane 123 percentage points, these incredibly stable, boring stocks are trading at a massive 40% discount on their trailing PE. This is an absolutely historic entry point before the speculative tide goes out. Which leads us directly into our playbook. We're looking at offense, defense, and hedge. For offense, you don't just blindly own the hyperscalers. You own the AI enablers and adopters. Those picks and shovels we discussed earlier, plus sectors like healthcare or finance, where AI actually boosts productivity margins, allowing you to completely bypass those messy data center construction bottlenecks. For defense, you rotate into that historically boring low beta trade to exploit that 40% discount before the 2027 lockup avalanches mathematically shock the high beta indices. And for your hedge, look to domestic energy. These are assets entirely insulated from the Strait of Hormuz that actually stand to benefit from the sticky inflation narrative. We've covered a tremendous amount of ground today, from the incredible momentum of the current streak to the very real physical and macroeconomic friction building on the horizon. I want you to take a hard look at your own positioning with this final thought in mind. As the 2027 CapEx ceiling rapidly approaches, is your portfolio built just for the streak, or are you actually prepared for the friction? Thanks so much for joining me on this explainer. Keep learning, stay focused, and I'll see you next time.